It's really great to be on the heels of Tracy Palangin's keynote talk today because we're actually talking about funding the social venture. And it's really great. I want to thank our conference organizer, Carl. Carl, can you stand up for me for just a second, please? Carl Choi is actually going into the investment space. I'm sure he's going to migrate more to the social space over time, for sure. But he's starting to get that fundamental training in the pure for-profit sector, and he's really been foremost and organized this panel. So I just definitely want to recognize Carl. So the topic today is really about finding the social venture, and this has been an exciting field for me personally. My husband and I not only have a foundation, we also have a venture capital firm, and then of course I am a co-author with the esteemed Laura Tyson. We're enjoying working together and recently wrote a blog as well as research on social financing. So this is something I deeply care about and am embedded with in the field from a practitioner and a research perspective. And I'm so pleased that we have this great group of panelists who can approach the finding and the funding of the social ventures from a variety of different perspectives. What I've asked each panelist to do, starting with Tracy and working our way to, from my right to the left, is just talking about the piece they play in funding the social venture and a little bit about the unique perspective and why their funding mechanism is different. So Tracy, do you mind if I start off with you?
Well, thank you again, Jennifer. And Jennifer's an old friend from Boston, so it's great to...
Not old in age, but old in time. I just want to be clear on that. I am old in age.
I'm feeling very old and wise. No, but I'll be very brief because you've heard enough from me this morning already. But I would reiterate that from a social enterprises perspective, what the social impact bond opportunity represents is a way to almost create a revenue model by solving our social challenges. And we work at the intersection of our social challenges and fiscal challenges, and that's where the opportunity is. So again, where could we invest in $1 of prevention to save many more dollars of dealing with the problem later is precisely the financing model, if you will. So how does one get ready to access this financing? Develop an evidence base so that one could model out what the quote-unquote expected outcomes would be. So if you imagine we recruit investors to invest in these projects, they want to know what they're investing in, this organization's track record, and they want to know at these metrics set forth by government, can this nonprofit achieve these metrics? What is the likelihood and the standard deviation, if you will, of the expected outcomes? So having data and having an evidence base would allow us to model that kind of information to attract investors. Also, having a great governance structure, having a great management team, very much akin to what a private sector venture capital due diligence process would involve, would be incredibly helpful to access this kind of finance. And ultimately, as I have said again and again, it's not a silver bullet. It works in only specific places where you could actually quote unquote create a revenue model by partnering with government to develop this financing.
So one of the things we're doing in this panel is we're going from those that fund kind of the more mature social enterprises to those that are really at the bleeding edge of the startup and the idea, if we kind of look at how we're organized across the panel. So Tracy, you talked a little bit about this in your keynote speech about how you're looking for really social enterprises that can measure their impact in a precise way and demonstrate results. So can you just explain a little bit, and we'll do this with each panelist as we go down, how proven is the social enterprise that you're funding, and then who's the sources of the capital? Mm-hmm. Wealthy investor, individuals, how does that work?
It's a great question. Ultimately, the evidence needs to match the kind of investment capital that you're trying to attract. If the investment source is grant money, in other words, these people don't expect a return on capital, then you can fund something with no evidence and could be quite innovative. But if you are trying to get money from the more mainstream capital markets, and we work very closely with financial institutions like Bank of America, like Goldman Sachs and others, they want to get something closer to a commercial rate of return, which is really the promise of these instruments, is to really open up the markets beyond that of grant money to expand the pie and expand the amount of capital flowing into the space. those kinds of investors, they want to know what they're investing in. They want to know their likelihood of getting their money back. And unless you have an evidence, you can't even model that out. I also would like to emphasize that we don't want to turn this very complicated instrument into just a very, very complicated way to do grant making. I mean, that would just fall short of our vision. So yes, Social Impact Bond 1.0 is very much about taking those proven models, proven organizations to the next level. And over time, we can think more holistically about getting into higher risk ventures, deploying different kinds of money.
So to Tracy's left is Mark Perutz, and he's Managing Director at DBL. Now, DBL's been a fascinating social impact venture capital firm to watch. They're in the process of raising their third fund, I believe, that's north of 400 million. So this is something at scale, which is very hard to do in the social and capital space. I mean, social finance is at scale, and also looking at the venture capital model at scale is also very challenging. So Mark, maybe you can tell us how you see DBL fitting into this framework of investing.
Sure. At first, thanks for having me here. I'm technically a partner, not a managing director, but I appreciate the promotion.
We won't tell Nancy. We won't tell Nancy. She's coming later. We'll keep that between us.
And also wanted to say that, Tracy, your talk this morning was fantastic and really great. Learned a lot there. It's not an easy topic to understand, but you made it pretty to understand, so thank you. And I also wanted to say that there was supposed to be one other person on the panel, Elisa from Indiegogo, which is a well-known crowdfunder, and I thought it was kind of fitting. Unfortunately, she's sick, which is not fitting, but I thought it was kind of fitting that of all the folks here, that's the one that isn't really seen, because they kind of raise the capital collectively behind the scenes, but are not really there to do any of the heavy lifting. That's up to some of the rest of us. So I am a partner at DBL. I've been there since the very beginning, almost 12 years next month. And so what is DBL and how do we fit in the piece of the social finance puzzle? Hopefully not a puddle. So you can just look at our name. So DBL, everyone here knows double bottom line. So what that means to us is we invest for the financial top tier rates of return, and we make no sacrifice on that. And then we also look to invest in companies that can have a positive social and environmental impact on the communities in which those companies operate. So let me drill down a layer further and kind of break it down, because there's a lot of firms that are double bottom line investments, but they are different flavors of that. So the way I like to describe it is we invest in two types of companies. The first type is companies that simply by operating and producing their product or service have an inherent social impact. And then the second category is the opposite of that. Companies that simply by operating and producing their product or service do not have a particular social impact, but those companies and their management teams and boards choose to be socially responsible. So examples of those two buckets. The first bucket, companies that have that inherent impact. Revolution Foods is a great example. We were the founding investor back in 2006. Kristen and Kirsten finishing up their second year of business school here. I'm sure it's a story that's widely known and widely told, especially around here. And then they came back obviously a year later and won the GSVC in 2007. Other firms, we've done a lot of clean tech investing. We were very early investors in Solar City and Tesla when in each case they had less than 100 employees. Now each of the firms have more than 10,000 employees, and about 3/4 of them are either manufacturing or installing jobs, which are hourly jobs, which societies need more of, particularly in the Bay Area. So the other bucket, what about the other bucket? So the other bucket, companies that simply by operating do not have a positive social impact, but choose to be socially responsible. A great example is Pandora, so the online radio company. I'm sure most of you guys are familiar with it. They were founded in downtown Oakland. They're still there 10 years later, simply by being in Oakland and growing in Oakland, downtown Oakland, which there's a lot more firms there now, but 10 years ago it was, crickets. And there's a multiplier effect by just being around and having a community of service providers be able to serve hundreds of employees working out of an area. They also worked with us to develop programs and practices that are either employee programs or community engagement or volunteering programs. You know, the famous example we have is that we help them, we call it adopt a music program at a local elementary school, Futures Elementary School in Oakland, which was a great fit for the company because everyone at Pandora loves music, and so Futures Elementary School had to cancel all of their music budgets. So they had no music education, and when Pandora heard about that, everyone at Pandora loves doing music, and that's the kind of volunteering that they're passionate about and want to do, and that's 8 years on now. They teach music to Futures Elementary School. That's probably enough for now.
Yeah, so at what stage, and we're going to work our way down the panel, but at what stage should social enterprises approach you? Now, Tracy, is it we'll call you and don't call us? I mean, I don't mean to say that, but quite frankly, they have to demonstrate the results, and you probably know who they are. And then, you know, Mark, Rev Foods was very early, like Nancy talks about finding them here, very early stage, but that's not common for venture capital. Typically, you're looking for the Series A round when they have a demonstrated track record and looking to go to scale. Right, so how do you look at approaching social enterprise and sector for potential funding?
This is for me or for Tracy?
Both of you,
Okay.
yeah.
Why don't you go?
Jennifer,
I know we're losing you.
No.
I want to get a lot of your time before you
It's horrible. First of all, I want to just, make a parenthetical statement. I love Kristen. She is awesome. The Revolution Food story is just an amazing story. In fact, it was one that we highlighted in the G7 report for impact investing,
Mm-hmm.
and Kristen and I were, it was one of these perks that we had, that we rang the closing bell at the New York Stock Exchange to celebrate the G7 report, and she and I were the bell ringers.
That's
It was
great.
just a lot of fun. Jennifer, you're right. We typically, we get a lot of inquiry, and most, and typically who we deal with are nonprofits. These are human services organizations. These are not the double bottom line, whether they're B Corps or startups and the much more in the social enterprise realm. These are your classic nonprofits. These are people who rely mostly on donations, whether it's large foundations writing big grants or very small checks. Goodwill, Salvation Army, Boys and Girls Clubs, Nurse Family Partnership, Center for Employment Opportunities. These are the organizations, and if they have an evidence base, we actually know who they are. And there are some fantastic movements around the country, in addition to Results for America, which talks a lot about evidence. Other movements like the Coalition for Evidence-Based Policy and others, where we actually kind of know how to find them. Also, several foundations have found this movement to be quite exciting and have asked us at Social Finance to help come in to look at their portfolio and actually provide assistance to help some of their grantees, quote unquote, become investment ready, if you will. So help them articulate that evidence, translate that evidence into a pay for success economic proposition, which is very, very specific, again, at the interface with the fiscal implications, right? So that's another way we can work as well.
Me too?
Yeah.
When should people approach us for social enterprise financing? At what stage? Really, at any time. We did invest in Kristen and Kirsten when it was a business plan and a tiny pilot. And there actually was a third founder, which a lot of people don't know, who was one of the students there. I think, particularly to this group, I think probably a lot of you folks are here for the contest and teams, and it's so international, which is great to see. Unfortunately, we only invest in companies that are headquartered in the US. It's just a limitation that we have in terms of how we raise our fund and what our LP investors expect. And I think we do tend to do more of a Series Seed or an A or even a B. And my colleagues Caroline and Victoria down the table here are probably more in the sweet spot for the really early stuff, which is I think a lot of the teams that are presenting today.
Thank you, Mark, and thank you, Tracy. Tracy's leaving a bit early, so I'm biasing this side of the table for for that particular reason. So I just want you to not neglect the people over here to my left. So Victoria is the managing director at Village Capital, and And then I was hoping that both you and Caroline can talk about what you bring to the table as far as the funding of the earlier stage, and not only the funding, but in many cases with Skydeck, providing the environment for them to succeed.
Sure. Thank you, Jennifer and Carl, for having me here. It's great to see you guys. So Village Capital is a system to find, train, and fund early stage enterprises. We actually have two pieces of our model. So a lot of the familiarity, if people have heard about us before, is with the accelerator side of our activities. So we run 3-month business development training programs for early stage enterprises all around the world. And we do 10 or 12 of these a year, 3 months long, with a dozen companies at a time that are focused on a particular problem. And the problems that fit within our impact mandate are in 5 different sectors. So the big change that we're looking to have in the world is twofold. One, addressing economic inequality, and for us that's focusing on access to education, health, and financial services. And then the second, to address environmental sustainability and resource scarcity, and for us we focus on sustainable agriculture and energy. So within those 5 sectors, again, we'll take a dozen enterprises in at a time, and we have a nonprofit that runs accelerator programs, and the stage of company that we're looking for in those programs have some amount of evidence base, so a different level than Tracy and her colleagues are looking at in social finance, but they've sold something to somebody. So they have an initial customer validation. They're post-revenue but pre-profit, and typically haven't raised much outside funding, if any. In 85% of the deals we've invested in, we've been the first capital in. And the twist in our model that differentiates us from other accelerator programs is that we actually believe very strongly that the entrepreneurs themselves, those people closest to the customer bases that they're serving, are the best ones to judge an investable product. They know the markets really well, they know the challenges really well, and we think we'll get different and better results if we give them some of the decision-making power. So we have them evaluate each other over the course of the 3-month program against our investment criteria, and at the end of each program, that leaves us with 2 early-stage investments. And that gets to the second part of our model, which is the side that I run on the investment fund. So coming out of each of these cohorts, we'll do about 20 to 25 early-stage investments a year. About half of these are in the US and half are international. Internationally, we've been active in India, East Africa, Mexico, Brazil, China, South Africa, and now we're closing our first deals in Nigeria and Tanzania. And those will be small initial check sizes, so between $25,000 and $100,000. And then more than half of our fund is reserved to do follow-on investments in these companies as they grow. So we'll go between $150,000 and $500,000. Again, based on where we are sort of in the spectrum, we expect those to be participation in continuing early stage rounds, typically at the seed level and maybe at the Series A, depending on how large a Series A round is.
And are your investors typically accredited investors? I mean, I know DBL has moved to now working with large institutional players, right, as far as investors. But are you still looking at predominantly accredited investors as being your source of funds?
Yeah, so the fund that we're raising and deploying now is our 3rd fund. We graduated out of what was initially, Village Capital was a part of a single-family office in another fund called First Light Ventures. And we were really trying to solve a sourcing issue for them, which is that it's incredibly difficult and really expensive to find qualified early stage deal flow. So the first 18 deals that we did were capitalized just out of First Light Ventures. Then when we were starting to get enough traction, we raised another pool that was a sort of club syndicate pool, and that was affiliated with Impact Assets, which some people may have heard of as a donor-advised fund. And now this 3rd fund is a fully for-profit independent vehicle that we manage ourselves. Our investor base is both high net worth individuals and foundations making program-related investments. Everybody in the fund wants to achieve both financial returns and social and environmental impact, and they're accredited or qualified.
Great. So it's interesting that you're in your third fund, you're now raising your third fund, and you've deployed out to many different states. You're starting to get a sense of the scalability on the social finance side. But equally interesting is UC Berkeley has now had an incubator, which is the first time they've cross-funded this across the university. And you're probably now in your third or fourth year, I would say, fourth year. So maybe you can tell us a little bit about that effort and how you see you fitting into this puzzle.
Okay. I'm Caroline Winnett, the Executive Director of Berkeley Skydeck. We are UC Berkeley's accelerator. We are a block off campus, so we're part of UC Berkeley, but we are in the work world. We're adjacent to downtown BART, the tallest building in Berkeley, on the top floor. We have 25 companies. They are all affiliated in some way to UC Berkeley. One of the founders has to have a UC Berkeley affiliation. It can be student, faculty, staff, or alumni, or it can be UCSF, or Lawrence Berkeley Lab. And we have no limitation on when you graduated. So if you went off to some large company and had the killer idea of the century, you're welcome to come back to Skydeck. We are, as I said, fully funded by the university, but we are also very much in the real world. I myself am a serial entrepreneur, and the university hired me to bring that perspective to Skydeck. So we draw upon the resources of the university, and that includes the astounding discoveries in energy, medical health devices that can change the world. And that's what really makes Skydeck interesting, is the kind of developments that happen here on campus can change the world, and they have, and they will. And those are the kind of companies that often end up at Skydeck.
Is it application-based?
It is application-based, and we have a 6-month acceleration program. We just closed applications, but we do take mid-session applications, so if you have a very hot startup, please come see me. We will be evaluating this round over the next month or so, and our next cohort starts June 1st. Some of the companies stay a little bit longer and incubate companies that come from, for example, the Baker Fellows Program here on campus, which you may have heard of, which seeds research by young faculty that has commercial promise. Some of those have ended up at Skydeck in terms of cancer detection, neuroscience hardware that can help people with epilepsy. These can have a big social impact. Our charter is not to take companies in any particular vertical or industry or type. Our charter is to take companies that are going to have a major impact. That can be social. And as we all know, the line between social investing and traditional investing is blurring. Mm-hmm. So some of our teams, they're all for profit, but they have a compelling social benefit, and they're drawing investment not just from traditional venture capital, but from social venture capital and interesting firms like we have here that see that there's a huge value in creating a social benefit and making that part of your charter to the market. And I think there's a real seismic shift in values in the millennial generation. I think that generation values a social benefit and will continue to do so, unlike us boomers who, as soon as we got to Wall Street, we forgot all about that. But I think things will change. And so I think the Warby Parkers, the Revolution Foods, the other companies coming out of Berkeley will not fade away as a trend. They will maintain.
Well, as a point to Carolyn's point, when Echo Devices is in her, and they actually have an iPhone app for heart detection, which can be applied to rural populations as well as just mainstream medical devices. And then when we look at Revolution Foods, what's been interesting in my conversations, Laura and I are writing a case right now on Rev Foods, is they sought funding from both traditional venture capitalists as well as social impact investors. They didn't limit the field, neither did Priya Haji, who founded World of Good, to just the social impact investors. In fact, I would say that both CEOs would say they benefited from collecting funds from multiple sources instead of just one source. Can you help us understand how we strike the balance in the portfolio companies or entrepreneurs that are seeking a social impact but also need to perform financially as well? I mean, at the end of the day, most of them are businesses and organizations, even if they're nonprofits, that have to perform to metrics, which you're holding their feet to their fire on, Tracy. How do you look at balancing those two? Because some people say these are sometimes at odds, right? But at the same time, they need to have some kind of blended result, which Jed Emerson, who came out of Berkeley many years ago, coined the phrase. How do you work and advise the organizations that you work with to manage that? Maybe I can start with Tracy, since I know she leaves in about 5 minutes, and work our way again.
Ironically, it is precisely this kind of funding that I've gotten feedback from the executive directors of the nonprofits that we work with that, wow, for the first time, I can be freed to do what I'm actually good at doing, which is program delivery. I don't need to go and fundraise. I don't need to host all these cocktail parties and these dinners and write lots of thank you notes and get on the phone. I can now focus on program delivery and actually be why I actually got into the sector in the first place. So it's been incredibly liberating for these EDs that we work with.
Great, and I thought it was fascinating in your keynote speech you talked about, you're focused on the outcomes, right? You're not tearing apart piece by piece or delineating, down to the minutia in their programs or over-managing it, which I think is also the criticism for funding in the nonprofit sector.
It's a highly collaborative partnership. We often have board seats on these organizations, and we get together on a weekly basis to look at how the data is coming through and making sure that we're in the same boat. We want them to succeed, they want to succeed, and so we see that tension less in our work.
Well, you guys have a seat at the board table of Rev Foods, but many other companies. I'm not sure that how much Tesla is reporting their social impact as a lead or not. How do you work on this? Because one of the criticisms in the social impact measuring space is that everything is unique, which makes it hard to scale. It makes it hard to have comparables, which we traditionally like in Wall Street across sectors or companies within sectors. Yeah. How do you look at managing that at DBL?
Well, in terms of measuring the social impact?
Yeah.
Well, I think Tracy kind of really did a really good job of talking about outputs and outcomes and impact, and also I read the GSVC judges guide and participant guide, and they also did a really nice job with diagrams and such. And I think the same thing you guys are really kind of tying these enterprises and initiatives or holding their feet to the fire in terms of not just being satisfied with the outputs, but also focus on the outcomes. I think we're still kind of at imputed impact, and I know I'm treading into dangerous water here because I'm not an expert in this sector. But the impact, we call it impact investing. It's all about impact. But really, as you talked about, it's more like outcomes. So in terms of our companies, Revolution Foods included, it's mostly about tracking outputs. And then we have some outcomes, outputs would be, are they serving meals? Mm-hmm. How many meals are you serving? And are you distributing? We track the number of meals we serve. We track the number and type of nutrition education that we provide. In terms of outcomes, it would be, are the kids eating all those meals, including the vegetables and the fruits? And are they absorbing and learning the nutrition education that we're providing to them, and kind of measuring that? It would be measuring like their body mass index and other sorts of things over time, glucose levels and cholesterol and those sorts of things, and you're having that impact, which is a lot harder and more time consuming, and quite frankly, the motivations are not there for, as you talked about as well, for the companies, be they for-profit or non-for-profit, to measure that. The motivations aren't particularly there for the investors, such as us, venture capital funds, nor foundations. I think that the real motivation would have to come from whoever is ultimately writing the checks that drive the whole system and cycle. And if they said, we're not going to participate in your next fund, or we're not going to make any more donations until we see, some studies, the RCTs, et cetera, I think you'd see more of that. But on the other hand, you don't want to throw cold water on all the things that people are doing. And if Revolution Foods, for example, and we've talked about it for years and years, but if, I think now probably for a company that's in its 8th year is probably about the time to really start focusing on that. But when you're in your first 5 years, you're really just trying to get out there, survive, get the cash flow positive, and you don't want to be saddled with too much measurement that's too hard and too onerous.
What's been interesting in talking to Kirsten and Kristen is the unintended positive consequences of their investment is because they're focused in school districts that need access to healthy lunches. I mean, you know, for some of these kids, they found out they had to introduce breakfast, right? Because it's maybe that's what they're going to eat that day. That's healthy. It's going to happen at the school. It's employment opportunities of employing first-time people that have had checking accounts, you know, in the inner city communities. And that's something that they didn't really think about or wasn't part of their plan or their social mission when they started, but it's become deeply embedded in how they think of their impact now in the communities they serve.
Yeah, that was actually, thank you for bringing that up.
Okay,
That's
welcome.
actually kind of part of what DBL does. So that's, I'm going to talk earlier in my intro about how we invest in companies that simply by operating produce a positive social environmental impact. We can, technically, we could just give them the money and walk away and never show up ever again. And if that company grows and succeeds, we can take credit for all the good that they do, right? All the meals they serve, 1,200 employees, about 3/4 of which are making the meals or delivering the meals, hourly jobs, good jobs. But part of what DBL does, what we think is somewhat unique for us in this space, is that we actively work to create these programs and practices. So we designed the financial education, financial literacy program that we've rolled out to the employees at Revolution Foods. We also, a colleague of mine, Lisa Hagerman, who runs DBL programs, is working on, with the company, on moving to full direct deposit, because about 40% of their employees go to check cashers, and that's about $300 to $400 of their money every year, which is real money, you know, for people who are making, you know, $12, $14, $16 an hour. Lisa Hagerman is also leading the charge for Revolution Foods on a vocational English as a second language program, because a lot of their employees don't speak English or don't speak it all that well, and that hampers your ability to get promoted because you need to be able to, you know, English is the lingua franca, the lingua English in Revolution Foods in terms of supervising. So those kinds of programs, we work with the company, we do those programs for people like Pandora that need those programs in order to qualify as a socially responsible company. And we do those programs for companies like Revolution Foods that don't need those programs in order for us to take kind of credit for investing in a company like that. But they very much need those programs and their employees in particular.
So at this point, we're going to again move to looking at more the international and how you look at social impact. But I do want to thank Tracy Planchen, because I want her to make her plane on time and see her family tonight. So I want to provide a nice open space for you to leave gracefully. So thank you so much, Tracy.
I'm so sorry. I really wanted to hear about
We'll send you the video link later, I promise.
Thank you so much for having me.
Thank you, Tracy.
And sorry, guys.
So if I can, Victoria, if you don't mind, so how do you think of your social impact? I mean, I think it's interesting, as somebody who is intimately involved with GSVC, as a former faculty director here, I know often when they're very early stage, it's hypothetical, right? You're talking about how they're thinking about measuring their impact, but they're just starting. And you're a little bit ahead of Caroline in this, in that you said you're looking for demonstrated results, but how do you look at the impact measurement piece of this when they're so early?
Yeah. No, I love how it's been set up so far, and I think in the sort of bifurcation or two-bucket model that Mark mentioned, we're on the first side of it. So companies that inherently, by the way they operate, their impact is fully integrated with their operational success. So throughout our program, we really have them focus on, we want to make it as easy as possible for you to report the impact that you're having, and you will have no motivation to do that if in reporting that impact, you aren't also seeing how your business is performing. Mm-hmm. So for us, we try to work with each company to have them really narrow down to 3 or 4 key metrics that when they look at whatever dashboard they're using to see, are we hitting our target numbers in terms of revenue, cash burn, and path to profitability, are we also getting a snapshot of the impact that we're creating such that when they scale, those two things are in parallel. So as we have more operational success in terms of the single bottom line of dollars, we're also seeing more impact success at scale. And there's the real challenge there is, has already been mentioned, is separating out what are the outputs from what are the outcomes, because most of what you'd be able to see on that type of dashboard is an output. So how many low-income patients are we serving in affordable rural healthcare clinics in India? Or how many people are we allowing to have access to some kind of saving structure that they didn't previously have because they were priced out by minimums or fees associated with it? And so we're trying to focus as much as we can their attention at a really early stage so that it's embedded in their culture and operation that they see those two things as really intertwined. And I think for the sector as a whole, it's great that people like DBL are focusing companies like Pandora on their impact as well. But that's not the space that we target.
You know, Brian Trelstein and I have had this debate too, and as you all know, he used to manage all the portfolio investments for Acumen Fund and now is doing bridges in the United States. But you know, it's hard to do the placebo effect. It's first of all very expensive. So if it's going to cost $250,000 and it's a nonprofit that is not generating anywhere close to that revenue, how can you possibly justify it? So it's kind of a process to get to that level of scale and accountability. And I know that you look at metrics at Skynet. How do you work with your startup, companies to really think about their metrics that matter and what they should be focused on as they're developing? And then how do you hold their feet to the fire and performing along those metrics to be entitled to stay as part of Skynet?
It's very organic. We're very close on top of them. And we have a very active mentor board, 35 advisors who are highly active, and honestly, they keep an eye on each other. So when an accelerator works right, it's a vibrant system where everybody is keenly aware of each other. There's some friendly competition among the teams, and they know that they are there for a limited amount of time with opportunity to take advantage of huge resources. In terms of how does the social impact evolve, I have two stories, and one of whom is here. One of my founders is in the back there, Nick Livingston, the founder of Honeit, who's here today, getting some advice from a Haas professor, taking advantage of UC Berkeley resources. Nick is a Haas MBA. And Nick's company, Honeit, makes a new interviewing platform that does something different. So typically an interview is conducted over the phone, someone has a conversation, and then those learnings from the conversation, which are really the important things, the interaction with a human being, it's hard to distribute that unless everybody else is listening to the conversation. So Nick's company, Honeit, has figured out a way to extract learnings from that conversation in an easy way so that can be distributed. The interesting nuances about the person, which is where the person shines. So here's what he's finding is that this platform can make someone shine who has a great personality, great energy and passion, but maybe they don't know the traditional way to make yourself look great on paper. They don't have a great degree, they don't come from a great school, their English isn't fantastic, they don't have a nice PowerPoint layout for their resume. That type of person who doesn't shine on paper, but they really shine as a human being. Getting those people a light shine on them when they're doing an interview process is a social impact, and it can bring opportunity to people who otherwise won't have it. So Nick's exploring that with investors now. And so that's a great example of a social benefit that's inherent in a company, but it's not the stated purpose of the company, right? We have another company that again draws on the great research at UC Berkeley. That's a company called Personal Comfort Systems, and they make a chair that you sit in the chair and you flip the switch to warm, and it senses you're there and it warms you up. If you're hot, you flip it to cool, and it senses that you want to be cool, then it cools you down only when you're sitting there. So what it's based on is not just someone's great idea. I think this is a great idea. I'm constantly cold and freezing. I love this chair. But it's based on extensive research at UC Berkeley, years of research that found that heating and cooling the person is much more energy efficient than heating and cooling the surrounding environment. So that's obvious, inherent environmental impact based on research. So those are the types of things that we focus on, because we're not looking for a return. But hopefully, if those things are really wired in and dialed in, when they come to your companies, you see a return and you invest.
Well, given the close nature of the working relationship too, you don't really necessarily, you're saying, have to wait for a report to be issued. You sort of know, when they're scaling, when they're doing well, when they're getting traction, and when they're sort of suffering in this limbo land of not being able to move
The
forward.
great thing about an accelerator is we see them every single day.
Yeah.
So whereas you guys take, data points and put together a story.
Right. And that's us also moving down the spectrum too, right? VCs have monthly meetings. I'm sure you're very actively involved too, but as you get to be larger, you're looking for more report-based metrics as well. At this point, I'd love to open it up to the audience. We have about 25 minutes left. If you're ready to go, that's great with a question. We do have some mics. It looks like we have some people that are ready to go. Otherwise, I have another question for the audience. Is it easier for you?
We also have an empty spot up here if someone wants to.
Yeah, exactly. Just
fill
join the
in right
panel.
now.
Laura,
Anything
well, feel free to
prepared, like a
come
back
up to the
pocket
table.
presentation or anything like that.
Hey guys, thanks again for your time and being here. One of the questions is actually from a comment that was just made. As I think about some of the most awesome social enterprises that I know, some of them don't have a clear exit, whether that's an acquisition or an IPO. And so that being said, I'm really interested to hear about how do venture capital firms think about these companies that may not have a financial sponsor that'll end up buying them or a clear IPO. Thank you.
This is a really great question and so important for the field in the social enterprise space. I think in GSVC generally we're seeing more for-profit companies that have a natural exit mechanism. For the nonprofits, loan repayments and other things are obviously the way that you need to go. But we've seen some really big acquisitions, right? With Annie's, Plum by Campbell's. I mean, we've seen some acquisitions, acquisition seems to be working, which is true for 9 out of 10 venture capital investments anyways that do exit are probably not going IPO, given the markets, but although it's improving. But how do you think of the exit? How important is the exit to ultimately proving, this role as a social finance mechanism?
Do you want me to start?
Sure.
You've
You've had a few big ones like Tesla, so I think you're going to...
We've done all right. Hard to tell if it's luck or skill. Only time tells. So it's all about finding the right investors, right? Right investors for the right companies and making that match. So, if you are a base the pyramid company and, maybe it's a for-profit company, but it's really more like a not-for-profit company in terms of you want to charge as little as possible and you're willing to have really low margins. That's not going to be a good fit for us because we're a US-based, we focus on companies that are based in the US and we also as I said earlier, make no sacrifice on financial return. So that's, you want to be talking to folks like Grey Ghost or Ignia or Acumen or Leapfrog or people that focus in that sector. If you're just go straight up nonprofit, then you can go to someone like Midyar who kind of does nonprofits and for-profits, or New Schools Ventures, which was in Rev Foods, does nonprofits. So I think it's about finding the right investor for what you're looking for.
I'm so glad you asked that question because I think it's getting a lot more attention in the space right now, and it's certainly something we're really focused on internally at our fund. Not just because of the supply side of companies who need an alternative sort of structure of capital, but the demand side from our investors who are saying, I'm totally bought into the premise of impact investing, but I am not sold on where the exits are going to come from. And frankly, there haven't yet been that many examples in the field that aren't at a much larger, later stage scale. So for people who are looking to put in early stage capital, it's a pressing question. For us, we have done a couple different things. So we're piloting in our portfolio revenue share agreements that enable us to still have what's an attractive financial return. So we're targeting a 2 or 3x equity multiple over the course of our investment, which we anticipate to be 5 to 7 years, so akin to sort of the traditional timeline for our fund. And that has been really appealing to some founders who don't want to give up much equity at the beginning and don't see themselves ever wanting to exit in a traditional fashion. I know there are other funds out there like Collaborative Fund that are experimenting with a couple different structures, and then there's been a lot of talk in the space about alternative instruments like demand dividend models. John Kohler at Santa Clara has done a lot of work in that space. So I think it's still very early. We've only done 3 of these revenue shares to date, and I've heard a lot of excitement about them, but haven't seen a lot of other people experimenting yet. But I think we're going to see more of it as people do want to fund a variety of different approaches that aren't always going to fit the traditional Silicon Valley exit model.
And Caroline, do you have equity in the firms as well, or as an incubator do you not? And then is the proof of concept when they actually get funded?
We don't currently take equity. We are looking to set up a seed fund, which would take equity as an option for the teams if they don't need the funding. We would not take the equity, and the equity would go back, of course, to UC Berkeley. But that's not our business model, so we are in the wonderful position of really not caring if they exit or not. So when Honeit becomes $1 billion company, Nick, if you want to keep it private, we're perfectly happy.
Well, take donations back, don't get us wrong, you know, but gladly, yeah.
But it's an unusual position to be in. You know, most accelerators are an exit model or a real estate model. We're neither of those. So really our 100% focus is on the teams.
Great. I know we have several mics. Let's go to the back and then we'll come to the front. So you have to fight for the mics, sorry. Go ahead.
So I'm just curious, how would you guys define anti-social investing? Because from what I've heard, social investing is anywhere from creating jobs to serving an underserved community.
So what are the anti-logs? You know, what are the investment opportunities saying, gosh, this just doesn't fit our parameters, this is not social enough?
Right, so yeah, when do you say, okay, yeah, you're creating jobs, you're meeting a consumer need, you've got a great device that meets a physical need, and you're going to benefit a community by being there, but it's not social enough?
Maybe these two, go ahead.
And maybe we'll have different opinions on this. So antisocial to me, like there's a difference between being explicitly destructive and just not additive. So it clearly would not fit our screens to be invested in something that we think is damaging to the environment or to people's health or livelihoods, or is increasing inherently economic inequality. That is a different camp than something that still wouldn't meet our thresholds, but just because we don't see enough impact integrated in the business model.
I'd agree with that, and I'd say that investing in social impact, the definition of impact is in the eye of the beholder, right? Or the eye of the investor. And in our case, it's the eye of the end person who's putting up the checks, which is our limited partner investors. So, you know, as I talked about, we invest in, you know, the inherent, you know, companies that inherently have the social impact and companies that choose to be socially responsible. And if people don't like that second bucket, then they shouldn't invest in our fund. Our thinking on that is that, you know, every company has some sort of impact. You know, is it going to be positive, negative, and we feel like if we just focus on the ones that inherently have it, there's a whole other world out there of people who can do really good things, and we want to make that possible. So, and that's what our LP investors like. And if they don't think we're doing a good job, and think we're doing too many of one bucket, or that the programs and practices that we're doing with those non-inherent impact companies are not sufficient, then they shouldn't invest in our next fund.
I think we have a question down here next.
Okay. Before I ask my question, maybe just a very brief introduction. I am one of the co-founders of a social enterprise called South Pole Group. We are Swiss-based, but we have offices in 14 developing countries, the big developing countries on all continents. And also like a World Economic Forum recognized social enterprise of the year kind of thing, right? And so we've seen a lot of stuff, right? And when you would ask me, how do we scale social financing, social venture financing? My answer would be, it's actually not so much about the enterprise, right? For me, it's about creating a platform, creating impact, social goods as assets that monetize, to remove that barrier between what is a financial return and what is an impact return, right? If we do that, if we have these things as assets for which there is a demand, and there is demand because, public entities want social goods. That's what governments are there for, right? To demand those, exactly. And to create a platform where there is an open incentive to all to create that on a competitive basis, right? A lot of the discussion that we have here around social enterprise, I almost feel we're talking about exclusive business model to create impact, right? And everybody does their own impact, which is non-comparable, etc., right? But if we standardize what we understand an impact to be, there would be multiple categories, right? And they're unit-based, and assets, and tradable, and bankable, right? We would create a system, an ecosystem, in which all of a sudden everybody who wants to play can play. And it becomes about money, and not about cause and caring, right? Which is always these altruistic behaviors, which maybe we find a lot of in this room, but not outside, right? Not in, like Wall Street, maybe, right? And then I think once we have that, and I've met that experience, it works, right? The leverage we would then have basically would give us the operation at scale that we need to get into the world of disruptive, where it really becomes a complete mainstream, right? As I come back, I've seen it from my own experience in the world of climate mitigation, where we managed to create a very homogeneous asset class. Right?
So your question is?
The question is, should we not also talk about that more? Or what's with the view of the panel on like to say, a marketplace for impact, right? It's regulatory, but it's also driven by impact investors to agree on the metrics of what is an impact, right?
So let me broaden this question out a little bit more. One of the things you talk about is what's still missing in the ecosystem, and it is too bad that Indiegogo wasn't represented here because they've been funding our teams, and crowdfunding has become a really important part of financing. But as you sort of look at your social entrepreneurs or your entrepreneurs and how they're trying to grow, is there a piece of this puzzle that still kind of seems to be missing out there, or are we doing a better job of filling that in?
I was going to answer
I
his
keep looking
question.
at you. I can look over here.
I'll leave your question for one of my other two esteemed panelists. I'll try to answer your question, which I think is slightly different than where you stand. I think that in terms of the metrics, and trying to, the holy grail of, being able to value the social good that each company creates according to metrics. So obviously that's been a question that's been asked of panels like this for 10 or 15 years, and I think it's still a holy grail. There's people out there like Paul Herman at Hip Investors, who I saw in this booklet. I don't know if he's one of the judges or on a panel or something, who've been trying to do that sort of thing. And Jed Emerson that you mentioned with blended value. My personal opinion on it is that you're never going to get people, back to the impact is in the eye of the beholder, right? So there's employee programs and how do you take care of your employees. There's environmental stewardship. There's community engagement, there's the carbon, and then you have to measure each of those, and then you have to weight each of those, and then combine it all up into a number, right? So Paul tries to do that, and Jed has tried to do it, but I think that it's hard to get agreement, even from, I don't know if Jen and Iris and their standards is going to get there. I think it's going to be really hard to get agreement on, because we do a lot of clean tech, and we want to have, I care a lot about the environment, and I might want to have, the environment and carbon weighted at a certain level, and someone might say, no, it's all about the people and favorable employee programs, and I think it's a false goal, and what we do is we just report what we do. So we report quantitative, as much as we can measure in outputs and outcomes, and also a lot of stories about what we do, like the programs we did at Rev Foods that I talked about earlier, and then we let our LPs decide, and we don't try to go down that. I think it's kind of a rat hole to try to figure out some grand unifying theory on valuing across all those parameters.
So Rev Foods is B-Lab certified. Does that help a little bit? Because at least they have 200 points that you can can register 80 on.
Yeah, but it's just B Labs waiting, right? So
Yeah.
I think it's more of a branding kind of good housekeeping seal of approval, and also a kind of alert to their investors that and partners, employees that, hey, we're going to care about other things besides just extracting the maximum amount of customer surplus and driving our financial bottom line.
So Victoria, did you?
Yeah, I mean, just really quick, I agree with what Mark said. We have our companies all get gears rated, which is a not perfect solution, but a starting point. And more so, again, to my point earlier, is a method for us to say, like, you're not going to score 200 at the level that we see you, but this provides a framework for you to begin thinking about some of these things and how to incorporate them. In terms of the question, I think people have tried things like social stock exchanges with very little traction, it feels like. We have market mechanisms on the public side that there are, ESG screened funds that take this sort of stuff into account, and that have demonstrated outperformance based on the impact indicators that they're looking for in public companies. So I think there are a bunch of proxies right now. The field is still trying to figure out the cost-benefit analysis for standardizing or making uniform any of these things, because investors do have such different requirements. And that's part of what makes the market work, is that some people will think that things are undervalued and they'll invest in them, and people will have different time horizons that they think, to be a good company over the long term, you need to take these impact considerations into account. So there's still a lot of diversity. I don't know that we'll ever get away from that.
So I think we have the mic here, and then I'd love this gentleman to get the mic next on this side if you could. So I think we have time for 2 more questions. You've been very patient in raising your hand.
Hi, I'm faculty in IIT Delhi from India. I just happened to be here, and it's lovely that I could participate. So I have a question for Victoria, because what is your experience with investing in Indian companies? I have been, just wanted to know, and if your your group is interested in medical device companies in India, which have direct social impact, like clubfoot problems, and I can discuss my problem offline, but companies like that. And the reason for that question is we do have funding from the government organizations like that, but it comes with a lot of hands tied down. How we hire, how we spend, there's a lot of bureaucracy which comes attached with that. So getting a funding which is free from that bureaucracy would let us do things in a much better way. So.
Yeah, just to keep it short, the first answer is very complicated. We've done 4 deals there. We're in the process of closing 2 more and trying to partially exit from 1. And it takes magnitudes longer for us to operate there than other markets. That being said, I think the pipeline of companies we see is so compelling that we'll continue slogging through some of the red tape. And we do invest in healthcare companies there. So if we have the starting point for us, again, is that we have to have a program that's dedicated to health. That's how we source investment opportunities. So happy to talk more later.
Okay, thanks. I'm Jason Cass with Toilets for People. So we make composting toilets for people in the developing world, focusing on the base of the pyramid. And you had mentioned before, like, a missing piece of the puzzle. And so our situation is a little bit of that, I think, in terms of we came into the space of impact investing, and a lot of the investors were looking for a high capitalization, intellectual property protection, proprietary technology, patents, so that there can be high profit and also social good in making toilets. But we found that that's totally unsustainable in developing countries where people need to fix stuff and repair stuff. And when you introduce a product that is patented and it's a black box, then it's just going to be junk in a couple of years. So we changed completely to become an open source, low capitalization enterprise that we want to farm out our technology to have other people do it. And if it's high capitalization, they can't afford to start out. And if there's patents in there, we're going to chase them down as the toilet police, and which is ridiculous. So we have trouble fitting in as a part of the puzzle. Like, investors like, well, if you don't want $2 million and you're not going to have patents, then I'm not interested in what you're doing. You're just a nonprofit. But we're for profit, but modest profit and high impact, because we want to. It's such a huge problem. We could never do it all ourselves. It's sort of like Tesla when you open sourcing his technology for electric cars. We're kind of doing that, but we don't really fit in. And also, we want to make toilet. We don't want an exit strategy. We just like making toilets. So we don't work. How do we Yeah, I don't know. Any ideas?
Yeah. Advice?
Yeah, I mean, I think the problem that you describe is a lot of the problem that we're trying to solve, being, working with companies before they need a $2 million check, trying to be flexible on the structures that they're willing to take in terms of investment capital. And it's a small community of people who operate at that seed stage and are not sort of fitting a traditional model. So happy to talk more later of people who might fit.
Last question here, which is, I know in DBL's case that you oftentimes work with the public sector and public sector programs and public sector funding. The discussion you just had is, at the end of the day, it's not clear that once you've developed the product and it's the right marketplace price point, that why wouldn't it be the case? Or I guess why is the public sector absent at this point? Why not say, this is brilliant, this really works, it's a low price solution to a common public sector problem. We should provide public sector money to scale this. We should be the ones. It's a public sector sanitation and public health are public sector goals. You've designed a brilliant product, shown that it can work. Why is the public sector missing, or have you tried to get public sector engagement in basically being the funder of this going forward? So a general question about the role of the public sector here, which I know in DBL, I know that you guys do work with the City of Oakland on employment generation, just as an example. So I'm trying to get the partnership aspect here.
Sure. Well, I mean, so yeah, we definitely try to work with public entities. Again, we're U.S. focused. Oakland, other folks, yeah. So we're no help to you, unfortunately. And I think it's going to be more the base of the pyramid folks and folks like Omidyar, who's willing to invest in. They don't care if the companies make money. They just nonprofits, not-for-profits, for-profit. Obviously the Bill and Melinda Gates Foundation has done a lot of work. You probably know a lot more about this than me. Just where we get involved with the public is all U.S. focused, and it's about bridging the gap between companies that have a technology, and it's proven at a very small scale, like a small new solar system that's deployed on, one building, or a small test pilot factory, and now we need to scale it up. And it costs $20, $30, $40, $50 million, and that's not the kind of money that funds like ours have, and that's when we need to go try to work with the Department of Energy, with grants and loan guarantees and incentive programs at the state and other levels, and we try to work in communities and say, hey, let's site that factory or that project in a low-income area in Oakland or somewhere, and then there's a whole bunch of other pots of money to tap into. So we kind of make that part of our stock and trade is to try to find all those pots of money and then connect and unlock them and bring them to our portfolio companies. And I don't know enough about what's going on outside the U.S. to help you on that, but maybe back to you.
We would love to work with public entities, and we hope to at some point. But I mean, the biggest problem, honestly, is like corruption in governments that we work, and just crazy bureaucracy and wild inefficiency. That's the biggest problem.
Those are three really big problems. Corruption, wild inefficiency.
Yeah. I think in the U.S., certainly we've had a lot of our companies get non-dilutive funding from SBIR grants or Department of Energy. Internationally, we've had some companies try, and to his point, the risk is that they die in the process of trying because it takes so long. And these, the number one rule is don't run out of cash. And right now we're working in India on a deal to try to get a facility that has been promised now for over 12 months to one of our startups that would enable them to skip a whole bunch of CapEx that they can't afford to do. And there is a risk that between now and the time they'll actually get that facility, they will run out of money and not be a company anymore.
Can I just ask the Swiss, I don't even know who was speaking about the Swiss activity back here, but what's the link to the public sectors around the world? Where you have all of these operations, it sounds like you're having a lot of success with scale. You mentioned the word regulation, which is a public sector issue. So what's the role of the public sectors in the various places you're operating.
And by the way, Ingo Pool is one of our finalist judges, so.
So, yeah, no, but I mean, the key in when we talk about climate mitigation was that governments put in place regulation that forced a group of companies, largely utilities, to buy social goods in relation to mitigation, otherwise known as carbon credits. Yes, exactly. So it's enabling regulation that turns a social good into an asset. And this story can be repeated across other asset classes. I am not for aggregation. I'm not saying we have this holy grail, this ultimate total unit, one unit. No, there's going to be a broad range. But let's try to create homogeneity within certain fields, within certain domains. Let's try to make them as large as possible, because that means liquidity. Liquidity is great for markets, right? And so it's like, and it can be a very incremental approach. And let's just move from one topic to the next.
Great. Well, I know that we're out of time, so I think at this point I'd like to draw the panel to a close. I'd like to thank all of our panelists for making the time to be with us today to talk about these important issues, and also recognize that Elisa from Indiegogo was ill. She would have loved to have been here with us, but it's best she's not here since she's not feeling well. We got an email this morning. So thank you to everyone, and we look forward to the next panel session that's going to be taking place in this room also. Thank you.
Thank you.